Basics about the election, no matter who wins, I think there's going to be opportunity. It just may be different depending on the situation. I think recession is back on the table, no matter who wins. I think that's going to be an interesting factor. Well, September tends to be a very ugly month for the markets. And then we're going to look at money flow, and then I'm going to end with actually my opinion on what I think the Fed might do or what the result is based on what their action is next week on the Fed Reserve meeting, which I think is which might even be more important than the election in some cases, which I know is, how dare I say that, but it's kind of what I'm thinking right now. So seasonality, I know in the election year, this goes back to 1928. This is what a typical election year looks like. Now, what's interesting is the peak usually hits, the end of August. Actually, this whole thing shifted back about a month and a half. This market peak actually happened right mid-July. And then we did have the sell-off just like that. Then we had a rebound. Then we had a retest. And now we're somewhere in here trying to figure it out. Typically September and the second half of September is the worst couple of weeks in the market in the year. So it's not going to be surprising that we have a rough couple of weeks at the end of the year and even into October. But I think this whole thing is probably going to be shifted back a little bit. So we may see the bottom maybe early October instead of late October, as is what's more common in an election year. And then after that, we could have a run. Then, it's messy until we know what the results are. And then after that, it's probably going to be okay for now. And then we'll get into, what happens after that, because that's much, much more important is what kind of environment we have. And I think it's not going to be the greatest, but that's different opportunity though. One of the big factors we look at regarding projecting recession is unemployment. The slope that we have currently, it's actually been rising steadily, and we haven't heard much about this, which I think is fascinating. This was in our newsletter this past couple of weeks ago, but this red line slope is exactly the same as this slope, just because I was curious if they were similar, and they're very, very similar. This here is what preceded the 2008 financial crisis. We're having a somewhat similar slope here. It doesn't mean it's going to happen, but it's something I'm like, if this starts to take off, then okay, something is definitely wrong, and we're coming into that environment. And I think it's possible at this. There's also a longer-term 18-year cycle, real estate cycle that I think about, and that would be peak somewhere around 2026 that matches up with this very well also. Of course, the other big recession indicator that we follow is the yield curve, which is the 2-year versus the 10-year Treasury yield. And when they invert, meaning that short-term Treasury rates are paying more than the long-term Treasury rates, you get an inversion. And that happened back in 2007, just like before. And then what happens after that? It unwinds, and then that's a problem for the markets. We actually touched it back in 2019, and then guess what happened almost a year later? That's what's interesting about it. About 12 to 18 months after the inversion undoes itself, which is right there, you typically have a very rough time economically. And we are right here pushing right. It's bounced through it a couple of times. It's really trying to hold on. I think next week, if they cut rates, this is going to just start taking off. So that's where I think we are on the rate cycle. And if that is the case, that is very likely in the next 12 to 18 months, we have a recession. Now, that's not necessarily good or bad. It doesn't have to be long. Typically, it can be, from a few months to a couple of years, depending on how much intervention gets in the way. I think that these things are meant to happen. They're meant to work themselves out. So I think it'll be ultimately fine, but it's something you have to be careful for, because we're going to go through a very rough period, and then things should be good again. And as a mentor once said, you can't have the good times without the bad times, and you can't have bad times without good times. So it's all part of the cycle and what has to happen. So I'm not bothered by it. You have to just look and understand the context and say, okay, based on this, we've got to be very defensive or very quick to be protective. All right, let's dive on to money flow. From a money flow perspective, it's strong. It's perfectly fine. Even though we've had more volatility lately, a lot more ups and downs, very quick. The money flow is still there. Money is coming into the market. When we're having a bad market like we did a couple of years ago, 2022, this was below the entire time. And the trend lines were, top left to bottom right. They were moving down, 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 down. And that's money coming out, kind of being afraid or being protective. And then once things turn around, you start to see money coming into the market. So I care a lot about this because it shows what the sentiment is. Are people voting with their dollars in the markets for it to go up versus not? And so far we're okay, but this is something I'm definitely keeping an eye on. If you watch this every month or read our newsletter, I try to reference these things frequently. I call this a long-term trend of ours. It's the 55-day of this data. So keep that in mind. I post it twice a month, essentially, so you can know what the status of this is based on the data that we give out. Short-term flows did go negative pretty quickly. We did peak August. So the July peak that I talked about was there. Then it came down. Then we had a retest, and then it didn't quite get as high. The market also did not. We had a failure, but it didn't go down as much. So I'm really curious to see how much money can come in. Again, coming into next week, the second half of the month, which is the worst week for the markets historically, and then the Fed having a news item, or they may cut rates, that could make things very interesting in the next 2 weeks. So definitely something we're keeping an eye on and being very, very ready to be protective or aggressive if we need to be. It's just an interesting time. Our sectors, negative to positive, we're +5, -6. Utilities have been great for months. It's wild. That's generally not positive for the overall market. Neither is real estate, consumer staples, and healthcare. Just popping back up is consumer discretionary. That's like the Googles and the Facebooks. For some reason, they're in that category. But generally, this is the defensive sides. The defensives are where the strength is. And if the offensives are on the weak side, that's not the best for the stock market environment. So keep that in mind. I want to see these cross over, and then I'm like, okay, we have a good run. But the rotation chart backs this up as well. Most sectors in this, between leading and weakening, they're just kind of bouncing back and forth here. But energy, which is just having a terrible time, is just way down into lagging. There's no reason to be in the energy space, at least currently. But technology and communications, this is really just all tech. They're pushing into lagging too. So we could get a bounce up like we're getting today and yesterday, but that could fail. If these all start pushing down into here, into the weakening, into the lagging, that's what it looks like when we get this retest of the lows, or we get a bad second half of the month. This all is set up to do just that. There's no reason to want to get too aggressive, but once these all push into here, then you're like, okay, you look for the improving, and that's when things start to all push up together, and then you get another strong market environment. And that could be as early as October. Could be the end of the month, but you have to let this play out first. So I'm keeping that in mind. And then finally, the Fed funds target. So this is a Tom McClellan chart, and I reference this frequently, but we have our own version of this. But I grabbed his because I loved how it lines up what the Fed funds does. So the black line is Fed funds, what the Federal Reserve sets rates, versus the 2-year yield on the Treasury bonds. And the 2-year yield is usually more correct about where they should be than they are. And Laura sent me a great article yesterday to reference for this, that the Fed, especially during election years, is very, very wrong historically. They tend to be more correct when it's not an election year. I don't know why that is, but it's, make your own conclusion from that. But so they've been holding rates steady for a while, as they were late to raise them. And then it looks like they are now very late to lower them. Rates should actually be down around 4% now, not at this 5.25%, 5.5% where we are presently. My prediction, my best guess, because ultimately we follow data and don't really make guesses. But if the Federal Reserve cuts by 0.5 point next week, then I think something is much, much worse in the economy than anyone is letting on. That is my guess. If it's only 0.25 point, then I think we might get the soft landing, although I don't think that's true, just as I don't think, what was the transitories? Anyway, the slowdowns, they're there. But back in 2007, they were late, just like they are now. The 2-year Treasury came down while they held rates, and then they were late. So we've got a very, very similar situation in unemployment, in the yield curve, and in the Fed funds versus the 2-year, that all matched up to what happened in 2008 before the big financial crisis. So the setup is there. Doesn't mean it has to happen, but I'm definitely paying a lot of attention to this right now.